Let's get the street's take on where stocks go from here. BMO Capital Markets Chief Investment Strategist Brian Belski has an S&P target of 5,100. He joins us here now at Post 9. Before we dig into that a little bit, just got a couple of pieces of economic data. What do you make of those reports? That consumer sentiment number very strong at 78.8 versus 70.2.
Well, good morning. Thank you so much for having us. It's been a while. So our case all along has been that this is not going to be about growth slowing down. It's going to be about inflation rolling over. And it seems to me, I'm still befuddled on how everybody thought the Fed was going to cut in March. I don't know where that came from. Fed funds futures have been wrong for 2 years. The bond market's been wrong for 2 years. And we stand by one thing: stocks lead earnings, which lead the economy. Stocks lead earnings, which lead the economy. And the stock market's been really strong, and it's telling you that growth is going to be strong. Remember, a year ago, everybody was worried about earnings rolling over, right? Now everyone's worried about earnings are too high again. It's the same rhetoric, but the trends are actually quite similar with respect to what we're seeing in terms of earnings revisions, and earnings growth is actually going up. So I'm not really understanding the rhetoric or the analysis behind it. This is not about growth, and Goolsby's, he nailed it. I mean, I think what's going to end up happening is that inflation is going to roll over, but the Fed's in no hurry. They don't actually need to drop rates, maybe second half of the year. So the way that we look at it as from an investment strategy perspective, we're not the economists, we're not the fixed income team. We think the first half of the year, 10-year yields hover around 4%, and the second half of the year, we hover around 350. And oh, by the way, that's on a path to normality, because remember, we've been anything but normal since 2007.
And so if the yields are where you say they are, aren't you surprised that tech is still as strong as it's been and that you predict that it will be strong going forward, even with yields sitting where they are?
No, Courtney, because we're overweight. We debunk a lot of the analysis coming out from some of our competitors talking about valuation. Now, valuation for the market in general is the worst predictor of future performance, but it is especially bad for tech. I think it comes from people that are trying to make sector calls and market calls, and they're not investors. We continue to think that those core tech names are consumer staple-ish like. Now, what we said in the fourth quarter was we were starting to see disparity in terms of dispersion with respect to valuation and performance among the Magnificent Seven and some of the other big tech stocks into other areas. So we think you can barbell and more growth at a reasonable price within tech, but that should be a core position for your growth portfolios. And then for value, we still like financials a lot.
Has earnings season so far ratified your view on banks?
Yes, because, I mean, you want to buy banks. Carl, you've been doing this for a long time. You want to buy banks when it's kitchen sink and they're cutting costs and everything's negative. You sell banks when everybody's really great, and you buy them when everyone's bad. There's no way we're seeing any kind of froth in the financial services industry because there's no IPOs. Now, there's some second half of the year, but last year, nothing. So we're cutting costs, we're negative, we over-reserved, we're already saying that we're going to have a recession. Where's the recession? And so we think that with those over-reserves, we're going to see more buybacks and dividend growth from the big banks.
We heard from Taiwan Semi yesterday, and obviously chips are an area of a lot of focus with AI, obviously their own nanometer technology, which is sort of market leading. But what do you predict for the chip space in particular within tech?
It's a great question, because last year was one of those, dare I say, late 90s, early 2000s, where you throw the dart and all the semis went up, just like tech stocks. Now, I think you had to take 2 steps back and you say, in my positions, you don't have to own everything. I think you want to own the leaders. In our view, it's NVIDIA and AMD, and you barbell it with more of a value stock like Broadcom and especially Qualcomm. And barbell and neutralize your positions there, but I think you want to be overweight other areas in tech and just kind of neutralize semis.